Right. So this is chapter 12 on leases. Not a long chapter. We probably will do it in three or four chunks, but it's an important chapter because um, it's really about this question of the substance of certain transactions that we're interested in here. Which is why this is important. I mean, we could look back at the history of leases. There used to be a standard called IAS 17 that dealt with leases, calling them finance leases and operating leases. And if you like, really, the theory here is, if you think about it, when you take out a long lease, when you take out a lease, all you do most of the time, if you think about it, is you just make these payments every single year. So on the legal form of it, it feels that all you're doing is just paying out these amounts every year, and it just feels like a straightforward expense. But the problem here is that where you control an asset and you will enjoy the life of that asset, and you maintain that asset because you can have these situations. In effect, what you have really done is to have taken out a loan, if you like, to buy an asset, just that the loan is provided by the very company selling you the asset, if you like, in effect, as opposed to you going somewhere else to borrow it in, a loan, completely different loan, and then buying the asset outright. You are paying back the company in bits, if you like, and if you like, using this asset. And so the substance of this relationship is this one of this idea of recognizing a loan and then buying the asset. So leases, there we are. So leases. So what is a lease? A lease is a contract or part of a contract that conveys the right to use an asset, if you like, for a period of time in exchange for consideration. So you're going to be using this asset, if you like, for a period of time. And so the lessor, this is the entity that's actually giving away, providing the right to use the asset in exchange for consideration. Just some definitions really here. The lessee is the entity that obtains the right. So this is the person actually taking away the asset to use for a period of time. And really, this idea of a right of use asset, I think the standard probably brought this in, I want to say about 3 to 4 years ago. I think probably 3 years ago, that we started calling this a right of use asset. So really, the asset itself, the fact that you have the right of use, is the asset. So that's what we recognize as the asset. And of course, there is the liability, of course, that we will also recognize. And so really, we're really just trying to understand how we recognize this relationship, if you like, of this asset. So here it says here, at the commencement of the lease. Yes, so in terms of initial recognition, right? What's happening at initial recognition? So at the commencement of the lease, the lessee should recognize a lease liability, and like I said, a right of use asset. So let's focus on the liability first. Now, the truth is, when we talked about financial instruments and we looked at loans and bonds, the truth is, everything in financial statement, everything really and truly, should be, if you like, at what we call the current value. When I say the current value, if you really want to get the valuation right, it should be very much at the current value. Really, all a liability is the present value, is today's value of these future payments. It has to be, right? This relationship of what is, if you take out a loan today, you will be paying some amount in the future. So you recognize, if you take out 10 grand today and someone says you have 10 grand today, you have to pay 15 grand in the future. That's one way of saying it. Or I could say you have to pay 15,000 in the future, and the present value of 15,000 today is 10 grand. That's all it is. So the liability that we recognize for this lease is the present value of all those payments that you will be making, if you like, in the future, over the steady period. And of course, typically with these relationships, we kind of know the people dealing in these things sort of already know what they want. So if you're taking out 10,000 and the whole idea is 15,000, we can work out, or if you're going to be paying, it doesn't really matter if you're going to be paying 1,000, 1,000, and then 15,000. We can kind of work out what the implied interest rate must be to go from 10 to 1 here and to 1 here and to 15, right? And that implied interest rate is given to us in the exam. Call it an effective interest rate, call it the implied interest rate, but it is the rate of the cost of borrowing, if you like, and the money that's going to the lessor, the person who lent it this loan. So, which is what interest is, the cost of borrowing. So we're measuring the liability at the present value of those lease payments that have not yet been paid. And we'll see, of course, how this works when we do the first test, the first TYU. But again, this is nothing dissimilar to the loans that we deal with. Right, let's look at the next one. So when we actually recognize the actual asset itself, so like I said, you will be recognizing a liability and you'll also be recognizing an asset. So when you recognize the asset, you must, of course, it makes sense, the very first thing as well, it must match the present value of that future final payment, so to speak, or the payments, if you like. So the present value, if you like, the asset. But when I say I would argue, the main one you see all the time is the fact that there might be some other direct costs that are not to do with the lease per se. It's to do with the lease, but what I mean is they're not to do with the loan itself. It might be some other direct costs, so legal costs or whatever it is directly related to the purchase of this asset, but they're admin type costs, but they're directly related. So we capitalize those as well. So we debit the asset and credit bank because we're paying for them straight away. So we're allowed to capitalize those as well. So the amount of any of the initial measurement of the lease liability, well, of course, any lease payments made at or before the commencement date. We'll see some examples of that. And sometimes we have this capitalization of this future dismantling cost or removal cost. So almost like a provision type thing, if you like, that we need to recognize as well right at the start of the asset. And that will unwind over the years until we finally pay it. So for example, I don't know, you would recognize the present value of the asset and you'd recognize a provision, and this provision will unwind over the years. You keep adding interest on it, and when it comes to the final time, you just then debit the provision in credit bank because you believe that you will pay 20 million, I don't know, to clear out to clear out this rig or something along those lines. So let's look at TYU1 here and see what the story is. So TYU1 says that, I might not have mentioned it, but we always look at the full length of the lease. When I come to I'll come back to the textbook and highlight a few points. We look at the full length of the lease, even we take the full extent, the full risk. So when I say the full risk, even any sort of temporary extensions, we look at the substance of this lease as opposed to what's even legal. So for example, you see it says here, Dynamic entered into a 2-year lease, but the contract contains an option to extend the lease for a further year. And it says here, they believe that it is reasonably certain to exercise this option. So it is likely that you will have a 3-year lease. And so that is how we should recognize this lease. So, first of all, again, as you can imagine, typically lorries can have whatever, and an asset can have a useful life of much longer than the lease. But I would argue from a matching point of view, you want to have the standard guides us, but I would argue that it makes sense to kind of have the life of the asset matching the length of the lease. I mean, it could be shorter. So for example, if the asset from a depreciation point of view is only going to last 2 years, then you'll do it over 2 years. But you really shouldn't do it over the 3-year, anything longer than the life of the lease, because once you do that, it's no longer matching with the actual liability connected to it. But if the asset is going to be transferring to the company, if it's going to belong to the company in the end, well then it's okay. You can recognize it over its useful life if that asset will be transferring, if you like, over to the lessee. But otherwise, it either has to be less or equal to the length of the actual lease itself. So let's look at this liability here. It says the lease payments are 10 grand every year. So I have 10,000 in the first year, year 1. I have 10,000 in year 2, and I have 15,000 for that final option period. And like I said here, the present value, the lease liability must be equal to the present value. So this is, you can see what I'm doing here, basically. So I'm basically finding the present value of this, present value of this, present value of this. And I know that this is being done it says the incremental rate of borrowing is 5%. So I literally want to discount this, if you like. So I divide this by 1.05. I divide this one here by 1.05 squared, and I divide this by 1.05 cubed. Right, and I'm just going to do that. I'm just going to do that right now. 10,000 divided by 1.05 is 95. I'm just going to write that here. So for year one, my answer here is 9523.8. For year two, I have 10,000 divided by 1.05 divided by 1.05. And here I have here 9070. And here I have 15,000 divided by 1.05 divided by 1.05 divided by 1.05. And here I have here 1295. I'll round that up to 12,958. I'm going to add all these three together, and that gives me the present value of my liability. So adding those three things together, 9070 plus 9523.8. Well, didn't need to do that really. Let's drop that. Present value is 31,551. So I'll do a T account in a second. So and then it also tells me that they incurred some direct cost of $3,000. So let me see if I can take myself to a clean T account. Keep, and let me just create a new slide and just create some. So that was three. Oops, sorry. That was three. I'll just bring that here. 31551. So here we are. So what I literally have here is here lease liability 31551. And here, of course, I do the same thing. The asset, the right of use asset 31151. And that's how we start. And you can see what I'm literally going to be doing here is unwinding this at 5% over time and paying off that 10 grand. And you will see that I get to the end like a classic, like liability. Calculate a finance cost every year at 5%, if you like, of the starting amount. Then you pay off 10 grand. And so 5% of this will increase this, and I will pay off 10 grand in the first year, and then I'll do 5%, and you'll see that the 5% is almost implied. Anyway, here is my just get my eraser here. Just take this out of the way. And then the last question, the last bit said that they incurred $3,000 of direct costs in that period. And so what I do is debit $3,000, of course, to the asset and credit bank. And then you have that. So this right of use asset I will depreciate over 3 years. Although to be fair, I'm not told whether or not the asset reverts back to whether the asset will be taken up by the person buying the asset, the lessee. But I'm going to assume and just go over 3 years. And then, of course, we do this every year. So let's just look at the answers very quickly, and then we can move on. We'll move on to the next video. So that's TYU1. Let's see what they put in there. TYU1. 1 second. TYU1. And very quickly, let's see how they went with that. TYU1. Come on. So here we are. So you can see they have 315. They had 31552. And so they just wanted the double entry. That's all they wanted. They didn't depreciate. What am I doing? They did not depreciate. They just wanted us to calculate what we'd be doing. So you can see their debit right of use asset 31552, debit right of use asset again 3, credit bank of course, and then credit the lease liability with the 31552. Cool, great stuff. And that brings us to the end of video 1.